September 2025 was a month of contrast, and it tells a lot about how the Indian equity market will play out in the coming months. We started on a note of positivity, and there was optimism all around. US Fed had cut rates then. Back home in India, we had seen big bag reform in the form of GST, and there was an optimism about renewed dialogue between India and US. It had a positive rub-off on Indian equity market in the initial part of September. However, with certain announcement around H1B and 100% tariff on pharma imported into US changed the mood. It rattled the investors' confidence, and we saw massive selling by FI of Indian equities in the later part of September 2025. If we see so far in this calendar year, FI have sold close to $17.5 billion, which is almost second highest on calendar year wise basis in last many years. And that also explains India's massive underperformance compared to other developed and developing countries. Nifty 50 reported almost 4.1% return so far in this calendar year in INR terms. In dollar terms, the returns are flattish compared to MSCI emerging market, which has given almost 24.5% return till September in this calendar year YTD. Majority of the other global developed market have given return of almost 15% to 20%. However, going ahead, we believe now Indian equity market is writing a narrative of resilience. We are now seeing the early incidence of benefit of GST reforms. We saw massive number being reported by consumer discretionary as well as auto companies in the start of this October month. We are very close to this quarterly season with Q2 FY26 number around the corner. We saw majority of the banks have reported very encouraging credit growth in between 4 to 6% quarter on quarter. This explains some sort of optimism which is visible in the month of October. At the same time, we are also seeing that the intensity of FI selling so far is gradually declining. Not only the valuation of Indian equities has come back to a more reasonable level at almost 20 times forward PE, almost in line with the last 10-year average, but what is really important going ahead is the trajectory of the earning growth. We at Fident believe that we are at the bottom of the earning cut cycle. Most likely, Q2 FY26 is expected to report anywhere between 5 to 6% EPS growth. Major of the heavy working will be managed in the later part of H2, where the earning growth is expected to be around 10 to 12%. Overall, we expect that Nifty 50 is expected to do almost 9 to 10% kind of an EPS growth for FY26. We believe this is in critical juncture where if we get some optimism between India and US on tariff dialogue, the revival in the EPS growth side, reforms by the government in the form of tax cut, GST rationalization and continuity of government capex alongside a very accommodative RBI policy bodes very well for the earning growth and for the equity market in the remaining part of this calendar year.